I think this is the most significant financial crisis in the post-war period.
Well, the financial crisis of 2008 and early 2009 was certainly the worst financial crisis since the Great Depression, and by some measures probably even worse than the Great Depression.
The 2008 financial crisis was one of the most significant economic events of the 21st century. It had a significant impact on people's lives around the world. The crisis led to widespread job losses as companies struggled to stay afloat and unemployment rates soared. Many people also suffered from foreclosures as they were unable to keep up with mortgage payments on their homes. Stock markets plunged, leading to a decline in retirement savings for many people. The crisis also had a ripple effect on the global economy, leading to a significant increase in poverty and social unrest in many parts of the world. Welcome to the Evening Crypto channel, where we cover topics that affect your finances and how technology is changing finance. In this series, I highlight some of the key events that marked the 2008 financial crisis and try to point out indicators that may lead to prediction of the next likely global financial crisis. The first key highlight of the 2008 financial crisis is the housing bubble. The housing bubble and the subsequent financial crisis have their roots in several factors, including changes in government policies, shifts in financial markets, and cultural changes. In the early 2000s, the U.S. government encouraged the expansion of homeownership by lowering interest rates and relaxing lending standards. This allowed more people to qualify for mortgages, even those who would not have been able to obtain them in the past. At the same time, financial markets were changing rapidly. Financial engineering was the hype of the time. Financial engineers were the most sought professionals. The securitization of mortgages, where lenders would pool together large numbers of mortgages and sell them as investment products, became increasingly popular. This created a large market for mortgage-backed securities, which were assumed to be relatively safe investments. As a result, a housing bubble began to develop in the mid-2000s. Housing prices increased rapidly, and many people took out mortgages they could not afford, often with low introductory interest rates. This resulted in a significant increase in demand for housing, which further drove up prices. Banks' greed played a significant role in the development of the housing bubble. In the years leading up to the financial crisis, banks and other financial institutions were focused on maximizing profits and generating high returns for their investors. This led them to engage in risky lending practices that contributed to the housing bubble. One of the key factors was the relaxation of lending standards. Banks began to offer subprime mortgages, which were loans given to borrowers with poor credit history or low income. These mortgages typically had high interest rates and included features like adjustable rates, which made them more affordable in the short term, but could lead to higher payments in the future. Banks also started offering exotic mortgages, such as interest-only mortgages, where borrowers only paid the interest on their loan for a period of time, and option adjustable rate mortgages, where borrowers could choose to make payments that didn't even cover the interest, leading to the loan balance increasing over time. Furthermore, banks began to package these risky mortgages into mortgage-backed securities, which they sold to investors in the form of bonds. Banks made huge profits from the fees they collected from packaging and selling these securities, and they were incentivized to continue making more risky loans to feed the demand for these securities. However, by 2007, the housing market began to slow down and housing prices started to decline. Many homeowners found themselves with mortgages that were larger than the value of their homes, and many were unable to afford their monthly payments when interest rates increased. This led to a wave of foreclosures and defaults, causing many homes to be put up for sale, which increased supply and caused housing prices to fall even further. This downward spiral led to significant stress on the financial system, as banks and other lenders faced significant losses on the mortgage-backed securities they had invested in. In September 2008, the crisis reached a critical point when Lehman Brothers, a large investment bank, filed for bankruptcy. This led to a freeze in credit markets as banks became unwilling to lend money to each other, which in turn led to a significant contraction in credit and a global recession. That introduces the second key highlight of the crisis, the Lehman Brothers bankruptcy. Lehman Brothers was a global financial services firm that operated as an investment bank and provided a wide range of financial services to corporations, governments, and individuals around the world. Founded in 1850, the company had a long history and was one of the oldest and most respected names on Wall Street. Over the years, Lehman Brothers built a reputation as a leader in the financial industry with a focus on investment banking, fixed income trading, and asset management. The company was known for its expertise in a variety of areas, including mergers and acquisitions, underwriting, and sales and trading. In the early 2000s, Lehman Brothers had invested heavily in the subprime mortgage market, buying and securitizing mortgages that were unlikely to be repaid. As the housing market began to decline in 2007, the value of these investments began to plummet, causing significant losses for Lehman Brothers. Despite these losses, Lehman Brothers continued to invest in these risky assets, increasing its exposure to the subprime mortgage market. Lehman Brothers also used a high level of leverage, borrowing heavily to finance its investments. This made the firm vulnerable to market fluctuations, as a decline in asset values could quickly wipe out its capital. As the financial crisis intensified in 2008, investors began to lose confidence in Lehman Brothers and other financial institutions, leading to a run on the banks and a liquidity crisis. In an effort to avoid bankruptcy, Lehman Brothers attempted to sell its assets and raise additional capital. However, these efforts were unsuccessful, as investors were unwilling to provide the firm with the funding it needed. As a result, Lehman Brothers was forced to file for bankruptcy on September 15, 2008. The bankruptcy of Lehman Brothers had significant consequences for the financial system and the broader economy. It led to a loss of confidence in the financial markets and increased concerns about the health of other financial institutions. It also highlighted the risks of investing in complex financial products, such as subprime mortgages and collateralized debt obligations, CDOs, and the potential for these risks to spread throughout the financial system. The collapse of Lehman Brothers marked a turning point in the financial crisis, as it highlighted the systemic risks in the financial system and the need for greater oversight and regulation. It also led to significant reforms in the financial sector, aimed at reducing risk and increasing accountability in the financial system. The third key highlight of the 2008 financial crisis are financial derivatives. Financial derivatives are financial instruments that are derived from other assets, such as stocks, bonds, currencies, or commodities. These derivatives are designed to manage risk by allowing investors to transfer that risk to other parties. For example, a futures contract is a type of derivative that allows an investor to buy or sell an underlying asset at a predetermined price and date. This allows investors to lock in a price and protect against future price fluctuations. Options are another type of derivative that gives investors the right, but not the obligation, to buy or sell an underlying asset at a predetermined price and date. While derivatives can be useful in managing risk, they can also be complex and difficult to understand. The underlying assets may be complex themselves, and the derivatives may have multiple layers of risk and complexity. This can lead to unexpected consequences and amplification of risk, as was seen in the 2008 financial crisis. One type of derivative that played a significant role in the crisis was collateralized debt obligations, CDOs. CDOs are investment products that are created by bundling together large numbers of individual mortgages. These products were then divided into tranches, each with a different level of risk and return. The idea was that investors could buy the tranche that matched their risk appetite, with higher risk tranches offering higher returns. However, the CDOs were based on risky subprime mortgages that were unlikely to be repaid, leading to a significant increase in the number of defaults and foreclosures. This, in turn, led to a drop in the value of the CDOs, causing significant losses for investors and financial institutions. The problem was compounded by the fact that many investors did not fully understand the products they were buying or the risks they were taking on. As the housing market began to collapse, the value of CDOs and other securities fell sharply, causing many CDS to be triggered. Financial institutions that had sold CDS found themselves facing significant losses, as they were on the hook to pay out on the contracts. This, in turn, led to a loss of confidence in the financial system, as investors became unsure about the solvency of financial institutions. Furthermore, the interconnectedness of financial institutions and markets meant that the losses suffered by one institution could quickly spread to others. This led to a chain reaction of defaults and losses that caused a systemic crisis in the financial system. In summary, the use of complex financial derivatives, such as CDOs and CDS, contributed to the 2008 financial crisis by amplifying the effects of the housing market collapse and creating a web of interconnected risks that led to significant losses for investors and financial institutions. The lack of transparency and understanding of these products further exacerbated the crisis, leading to a loss of confidence in the financial system and contributing to the broader economic downturn. The fourth highlight of the 2008 financial crisis is the Bear Stearns collapse. Bear Stearns was a global investment bank and securities trading and brokerage firm that collapsed in 2008, becoming one of the early victims of the financial crisis. The collapse of Bear Stearns was a result of a combination of factors, including its exposure to the subprime mortgage market and the loss of confidence in the financial markets. In the early 2000s, Bear Stearns had been heavily involved in the subprime mortgage market, investing heavily in mortgage-backed securities and collateralized debt obligations, CDOs. These were risky investments, as they were based on subprime mortgages that were unlikely to be repaid. As the housing market began to collapse in 2007, the value of these investments began to plummet, causing significant losses for Bear Stearns. Bear Stearns also had significant exposure to the commercial paper market, which is used by corporations to finance short-term obligations. As the crisis spread and confidence in the financial markets declined, investors began to withdraw their funds from the commercial paper market, causing a liquidity crisis. Bear Stearns was unable to secure the funding it needed to continue operations and was forced to seek assistance from the Federal Reserve. The Federal Reserve worked with J.P. Morgan Chase to provide a $30 billion loan to Bear Stearns to help it weather the crisis. However, this loan was not enough to prevent the collapse of Bear Stearns. In March 2008, J.P. Morgan Chase acquired Bear Stearns for just $2 per share, a fraction of its previous value. This represented a significant loss for investors and was a sign of the severity of the financial crisis. The collapse of Bear Stearns had significant consequences for the financial system and the broader economy. It led to a loss of confidence in the financial markets and increased concerns about the health of other financial institutions. It also highlighted the risks of investing in complex financial products, such as subprime mortgages and CDOs, and the potential for these risks to spread throughout the financial system. In response to the crisis, regulators took steps to increase transparency and oversight in the financial markets with the aim of reducing risk and increasing accountability in the financial system. These included new regulations for derivatives trading, increased oversight of financial institutions, and the creation of a consumer protection agency. In short, the collapse of Bear Stearns was a result of its exposure to the subprime mortgage market and the loss of confidence in the financial markets. It highlighted the risks of investing in complex financial products and the potential for these risks to spread throughout the financial system. The consequences of the collapse of Bear Stearns were significant, leading to increased regulation and oversight of the financial markets. The consequences of the 2008 financial crisis was an eventual global recession. The crisis had far-reaching and long-lasting effects on the global economy, as it impacted financial institutions, businesses, and households around the world. In the aftermath of the crisis, many countries experienced a sharp decline in economic activity, as businesses cut back on investment and consumers reduced their spending. The banking sector also faced significant challenges, as many financial institutions were burdened with toxic assets and faced a liquidity crisis. The global recession that followed the financial crisis was one of the most severe in history, with many countries experiencing negative GDP growth rates and high levels of unemployment. The crisis had a particularly significant impact on the European Union, where several countries, including Greece, Spain, and Portugal, faced sovereign debt crises and required bailouts from the European Union and the International Monetary Fund. The global recession also had a profound impact on the global financial system, leading to significant reforms and changes in the regulatory environment. Governments and central banks around the world implemented a range of bailout mechanisms to stabilize the financial system and support economic recovery. Some examples of these mechanisms are Troubled Asset Relief Program, Federal Reserve Programs, European Central Bank loans, bank recapitalization, and economic stimulus package. In the United States, the Troubled Asset Relief Program was a program that authorized the U.S. Treasury to purchase troubled assets from financial institutions, inject capital into banks, and provide assistance to homeowners facing foreclosure. The Troubled Asset Relief Program was credited with stabilizing the U.S. financial system and preventing a complete collapse of the banking sector. The U.S. Federal Reserve implemented a range of programs to provide liquidity to financial institutions and support credit markets. These programs included the Term Auction Facility, which provided short-term loans to banks, and the Term Asset-Backed Securities Loan Facility, which supported the market for asset-backed securities. In Europe, the European Central Bank provided loans to European banks to address the liquidity crisis that followed the financial crisis. These loans helped to prevent widespread bank failures and stabilize the European financial system. Many governments provided recapitalization to banks to help them withstand the financial crisis. This assistance included direct capital injections, guarantees on bank debt, and the purchase of distressed assets. Governments around the world also implemented economic stimulus packages to support economic growth and job creation. These packages included tax cuts, infrastructure spending, and other measures aimed at boosting consumer and business spending. The bailout mechanisms put in place after the 2008 financial crisis were critical in stabilizing the financial system and preventing a deeper and more prolonged recession. While there were criticisms of some of these programs, many experts agree that they were necessary to support economic recovery and prevent a systemic financial collapse. There were also regulatory reforms that were also put in place aimed at preventing similar crises from occurring in the future. The first regulation is the Dodd-Frank Wall Street Reform and Consumer Protection Act. This legislation, passed in the United States in 2010, aimed to improve accountability and transparency in the financial sector and to protect consumers from abusive financial practices. The law created new oversight bodies, increased capital requirements for banks, and introduced new regulations for the trading of derivatives and other complex financial instruments. The second regulation is the Basel III. This international regulatory framework, developed by the Basel Committee on Banking Supervision, introduced new capital and liquidity requirements for banks. The aim of these requirements was to make banks more resilient to financial shocks and to reduce the risk of bank failures. The third regulation is Volcker Rule. This regulation, named after former Federal Reserve Chairman Paul Volcker, aimed to prevent banks from engaging in risky trading activities. The rule prohibited banks from engaging in proprietary trading and limited their ability to invest in hedge funds and private equity funds. The fourth regulation is the European Market Infrastructure Regulation. This European Union regulation introduced new requirements for the clearing and reporting of derivatives trades. The aim of these requirements was to increase transparency in the derivatives market and reduce the risk of counterparty default. Another regulation put in place is the creation of the Financial Stability Oversight Council. This U.S. council was established to identify and monitor potential risks to the financial system. The council includes representatives from various regulatory agencies and is tasked with identifying emerging risks and coordinating responses to potential threats to financial stability. Overall, the regulatory reforms implemented after the 2008 financial crisis aimed to increase transparency, accountability, and resilience in the financial sector. While there is debate about the effectiveness of these reforms, many experts believe that they have helped to reduce the risk of another systemic financial crisis. But the truth of the matter is that while the global economy eventually recovered from the 2008 financial crisis and the subsequent recession, the effects of the crisis are still being felt today. Many countries continue to face economic challenges, and the crisis highlighted the need for greater oversight and regulation in the financial sector to prevent similar crises from occurring in the future. On the other hand, having understood the history of global financial crises, right from the Great Depression of 1929, the Asian financial crisis of 1997, the dot-com bubble, the 2008 global financial crisis, to the recent European sovereign debt crisis between 2009 to 2015. Some experts are speculating that the cryptocurrency hype may be leading us to a similar situation. That is partly because of its similarities in the hype with the dot-com era. There is another video that covers the crypto hype and what to expect in the coming years. The link is in the description. Do not forget to subscribe to the Evening Crypto channel to get updates on the latest financial technologies and innovations.